Hello and welcome to the fifth edition of Standard Chartered Wealth Masterclass, where our endeavor is to de-jargonize key investment concepts and making investments simpler for our viewers. My name is Ravi Singh. I'm the Chief Investment Strategist for Standard Chartered Bank India. I will be the host for this webinar. Every month, we come out with new topics that are of interest to you and something that is very topical. The topic for today's discussion is passive versus active investing, something that you would be interested in understanding because there's a lot of debate about the efficacy of passive style versus active style. To help us through this, we have a very interesting guest today, Ms. Radhika Gupta, MD and CEO for Edelweiss Mutual Fund. Radhika needs no introduction. She has over 15 years of experience in global asset management across organizations like McKinsey, Edelweiss, AQR Capital. She's a renowned storyteller with a popular personal tale, a distinguished graduate, a recognized leader on AMFI. She's currently the Vice Chairman of AMFI as well, and Young President's Organization of Mumbai. She earned accolades from Economic Times, Business Today, and Fortune is one of the most powerful women in business and is a top voice for LinkedIn. Radhika, without further ado, I will hand it over to you to help us understand the debate on what is passive versus active style of investing.
Hi, good afternoon, and it's a delight to talk to you. Give me half a second, and as I also try to share my screen, and I'm hoping if someone could confirm that you can see my presentation clearly.
Yes,
and you can hear me clearly. Okay, great. Well, thank you so much. So excited to be talking to all of you, about a topic that has gotten so much attention, which is passive versus active investing. And my endeavor is to hope to simplify this topic, keep this afternoon also a little bit interesting. But I thought before entering the backdrop of passive versus active investing, given the kind of markets we are in, I would spend 10 minutes talking about another very important component of investing and thinking about portfolios, which is really the importance of emotions. We can spend a lot of time debating matters like active or passive or how to structure portfolios. But in my almost 20 years of experience in investing, I think investing is very, very emotional. Most people don't wake up thinking, am I going to buy an active fund or am I going to buy a passive fund these days? I think money exists for a much larger purpose, and that is to solve goals, to have a better life. Money is also something that is a result of so many influences that we've had throughout our life. As children, it's a sense of identity for many people. So money is a very complex topic, and many of our investment decisions can be extremely emotional. So I thought it would be good to just walk you through a few thoughts, especially as I said, in these kind of markets, to try and make investing a little less emotional, because while emotions are a wonderful thing in life, they may be perhaps a less good thing in investing. And one of the most unfortunate pieces of data about investing is actually what you see on this screen, is that while we spend a lot of time trying to pick the right fund and the right asset class, and as I said, passive or active, if you look at the average investor, which is the person represented in the orange graph, and the returns they have versus the S&P 500, which is indeed a passive fund, the average investor significantly underperforms even a basic index. And I don't think it's because of the products that they've chosen. It's really about entering at the wrong time, exiting at the wrong time, and making those kind of emotional decisions. The famous Isaac Newton, who all of us know and is a genius, once said that I can understand the most complex laws of physics, but I struggle to understand basic emotions in investing. And if that was a problem for Isaac Newton, then it can be for all of us. And in my experience in managing money across geographies and time periods, I would also say that behaviors don't have borders. So the story I shared from the US translates completely well to the experience of investors in India as well. A few years ago, there was a craze about cryptocurrencies, and I was in Delhi and I was home for Diwali. And many people would ask me, Radhika, should I invest in crypto? Should I invest in crypto? So I would then ask them, why do you want to invest in this asset class? And the most common question or the most common answer I got was, well, my friend did it and he or she made 30% return or 40% return or 50% return. The answer was not, oh, I understand this asset class fundamentally and here is why it's going to make money, or this asset class is really cheap and this is what's going to happen. It was just someone else did it and made a lot of money. In very simple terminology, that is FOMO. I keep joking, my 14-month-old baby has FOMO. So if there's a party at home, he refuses to go to sleep because he feels he's missing out on something. And while that may be okay in a party, FOMO has led to perhaps some of the worst investment decisions. So never make a decision based on FOMO. And as I said, there's an interesting statistic that if you look at the time period of returns, so the second column here shows in any given time period, this is a study by Morningstar called Mind the Gap. This data here in the middle shows you the total return that a benchmark index has earned or that a fund has earned in a particular period. So in 3 years, if a fund has earned 10.5%, the average investor return was actually only 9%. The same thing is true in 5 years. The same thing is true in 10 years. And again, it's because of our timing of entry and exit. There's also interesting data to say that, when we make decisions, some of our worst decisions are actually made in negative markets. So our decision to exit asset, again, this is an example with a passive index, the S&P. In 2018, when the S&P fell 5%, the average investor return was 9%. I always say that avoid making decisions when there is a storm. No sailor will adjust his sails too much or change their strategy when there is a storm. So avoid taking too many decisions in panic, decisions about your asset allocation, decisions about what you want to do, because in a down market, really our emotions get the best of us. And I just wanted to quickly give you five thoughts to think about as you think about managing investing and managing your emotions. The first is really the importance of headlines. And, every time the market is down a couple of percent, you will have headlines saying X trillion dollars of market capitalization written off. And a mutual fund NAV may fall once a day, but because of the headline value on the news, on WhatsApp groups and on everything around you, actually you feel an NAV cut 5 to 10 times a day. The reality is much of this news is not very relevant to us. So if you are investing in an index fund or if you're investing in an active fund, what are you investing in? You're investing in stocks, but actually you have part ownership of companies. Now, companies can't be making headlines every day, right? The long-term economic prospects of companies just can't be making headlines every day. So it's important to question how much these headlines matter. In fact, some of the best people in the investment management profession I know are those that have consciously chosen to avoid reading the news, staying off social media, and just isolating themselves from all the noise that's around us. The second is, and I'm going to give you a personal example, but I tell most people that if you look at your life on a day-to-day basis, it's really difficult. You're going to be stuck in traffic, your car is going to break down, you're going to have a fight with your spouse, you'll get annoyed by some project at work, and life on a day-to-day basis is extremely complicated. It's extremely volatile. But if most of us look at our lives over a 10-year horizon, we'll find that we're living in a better house than we were 10 years ago. We'll find that our family is probably better. We have, wonderful set of kids. They're going to school. They've grown up so well. We have good relationships, and we'll find a lot more to be thankful for. Day-to-day life is volatile, but when you zoom out of the day-to-day, things are better and the volatility appears far less. The same is in market. So zoom out a little bit. The day-on-day corrections can exhaust any investor, but when you start to look at things over a 3 to 5 year horizon, you'll actually find things are not very volatile. Even your returns are not very volatile. The third point I wanted to make, and when we talk about passive funds, we'll also talk about diversification. But the winners keep changing in the market. So, if you look at this chart, and it's got so much on it, but if I could just explain, it just shows different asset classes and when they've done well. So, for instance, in 2022, commodity was the best performing asset class, and small cap was the worst performing asset class. This is global assets. On the other hand, in 2020, small caps were the best performing asset class and commodities and REITs were at the bottom. You really can't time the winners. You can't figure out whether it's an equity year or whether it's a debt year or whether it's a commodity year. So diversification is one of the best things that you can do in your portfolio. The fourth, and this is one of my favorites, is going back to the big picture. Going back to, and this is going to lead into our next discussion as well, going back to why I started investing. What are the big picture questions? The reality is macro news doesn't concern you as much as your own financial goals, your own financial situation. So ask yourself periodically, I've invested 5 years ago for a certain set of goals. Are those goals the same? Is my time horizon the same? Is my financial situation the same? Have I changed jobs? Has my spouse changed jobs? Do I want to start a new business? Maybe you want to start a new business that necessitates that you have to be more conservative. Maybe you have to take on a new set of liabilities. Ask yourself these questions. I think these are much more, important questions. And if the answer to these kind of questions is yes, then you really need to think about changes in your portfolio, not, the Indian economy did this or the interest rates fell by XYZ%. Personal finance is personal. And last one is, a great way to make investing simple, in my view, is just to automate things. So to take less decisions. I've been an investment professional for a while, and people often ask me how I manage my own money. The reality is I let SIPs and asset allocation funds do most of the tricks. Because the best way to keep emotions out of investing is to just put process and the method to the madness. So SIP for me is an automatic way to save and invest. I don't need to worry about when the market is up or down. And you'll realize if you do that, actually the outcomes are not as bad as you think. So with that, let me move into the topic.
You're on the topic. Yeah,
Yes,
since we're on the topic, maybe just one question from my side. Well, whatever you've said, some of our investors would have heard this, but it becomes very difficult to look at a screen which says 10% down during the day.
Yes.
Maybe over a week, investments down 15-20%. How does one avoid the temptation of not taking a radical call at that point? What should an investor do at that point?
So a few thoughts. One is look at your portfolio less. Seriously, I think, if I try to look at my own portfolio once a quarter, and this is something that surprises people because, seeing that cut, seeing 10, 10, 10 down every day is one more cut in your head. Secondly, I think, always remember, I'm going to reiterate a point I made before. A crisis is the worst time to take a call. So even if you want to take a call in your investments, when your portfolio is down 10-20%, do something to shut off that screen and not take a call, because remember, you're not in the best headspace. If you have had a car accident, it's probably not a good time to retest your driving skills, right? You might want to do that when you're in a calmer frame of mind. So that's important. And then third, ask why you invested. This really matters. So if you've invested for 5 years and your investments are down 10% in 1 year, ask yourself, why am I stressing? Do I need the money today? Probably not. I invested for 5 years, right? So I can close this and wait. Was this contingency money that I needed to pay for a house in 2 days? No, it was not. I allocated it rightly. I know what I'm invested in. Ask yourself why you're panicking, and I think that really helps.
Thanks, Radhika.
So let me move into the topic of the day, which is active versus passive investing. And I'm going to walk through this presentation with an analogy that may seem strange to you, because I don't think most people, I think people think of the world as active versus passive, but I don't think the world is that way. I think active and passive are two decision-making choices that you have, two kind of products, and they both have merit. Now, let's reframe the problem since it's lunchtime in a very different way. And let's ask ourselves that if we wanted to eat pizza, which is incidentally one of my favorite foods, what are our options to eat pizza? And I'll tell you where this is going. One is that we go into a really nice Italian restaurant, where there will be a particular chef and he's going to serve me, a pizza of my choice. And I'm going to pick an Italian restaurant that I like, that's been highly rated, where there's a good chef. The other option is, I don't want to do all this. Yeah, who's going to go through Zomato or whatever it is and find a good restaurant and figure out the chef? And it might be expensive. Let me just go to a place that just serves standardized pizza. I don't have too much time to think about this. Let me go to Pizza Hut. Let me go to Domino's. That is active and passive investing. On the left, your fine dining restaurant to me is your active fund. It is a fund in very simple terms where there is a chef, there is a fund manager who aims to do better than a standard experience, which is Pizza Hut in this case. So it's a fund that aims to do better than the standard experience, which is the market. You're going to get something new. You're going to get something different. The chef is actually taking active calls here. And the other option is, if you don't want to take decisions, there's a standard solution for all. That is a passive fund where you know what you get, and that is just the market. That's the way I would think about active versus passive. And, as you think through, as you listen to this presentation, keep asking yourself, what's the best way to eat pizza? Now, let's just talk about the difference between active versus passive funds a little bit, and go into a little bit of detail. So in an active fund, the fund manager's job is to pick specific stocks in an index. So if you take a large cap fund and the index is Nifty, in an active fund, the fund manager's job is to choose stocks from those universe of 50, assuming some stocks in the Nifty he thinks are not so good and some are better. And the aim is to beat the Nifty. A passive fund is a Nifty index fund or a Nifty ETF, and it will manage and build a portfolio that holds all those stocks in the Nifty in the same weight as the Nifty. So in very simple terms, that is passive and active investing, obtained. Imagine again in our pizza example that there's a standardized document of how to make pizza that exists at Pizza Hut. That's what a passive fund is. An active fund wants to do that. So the difference between an active fund and a passive fund is just the way it is managed. By the way, if you can notice one thing, in both active and passive funds, you are eating cheese, you are eating refined flour, and you are eating tomato sauce. One is not particularly less risky than the other. Both are fundamentally the same dietary components. It's not that an active fund is, refined flour and a passive fund is broccoli. They're both very similar. It's the way they're managed that's very different. And I'll tell you why I'm talking about this in just a bit. Now, expectations. What should your expectations be when you're investing actively? What should your expectations be when you're investing passively? Well, in passive fund, your expectation should be, there is a standard. I just need to mirror the standard. I can't be worse than the standard, but I just need to broadly mirror the standard. In an active fund, your expectation should be, there is a component of research and analysis that is done with the fund manager. And of course, depending on changes in economic climate, market situation, company fundamentals, there will be changes in portfolio. The cooking analogy is, there's a really cool new pepperoni or broccoli or whatever inviting in the market, hopefully, or a white truffle that has been discovered. Hopefully, the chef might adapt his recipes to that, his or her recipes to that. Now, a few basics to keep in mind as we think about active and passive investing, and this will help you in your decision-making process. So again, to simplify, passive funds will give you returns that are of the benchmark minus a fee they charge. Of course, nobody works for fee. Passive fund will give you return minus it. The fund has the potential to give you higher returns than the benchmark. It could give you worse returns than the benchmark. It's just like a fine dining restaurant should hypothetically give you better food than Pizza Hut, but you just might not like it and it might be worse. In both cases, in a passive fund, you will get risk that is exactly in line with pizza. Now, in an active fund, you have the option to have volatility that is less than the benchmark if that's managed well. Just like in an active pizza management, you might have a product that is marginally healthier. Now, active funds are of all kinds, passive funds are of all kinds. So in both categories, in both active and passive, you have many different categories that exist. So you have large cap passive funds, you have large cap active funds, you have small cap passive funds, you have small cap asset funds, passive funds. There are some styles that lend themselves better to passive funds, in my view, some styles that lend themselves better to active funds. There are styles, in my view, that lend themselves completely to active management, and some styles that may lend themselves almost completely to passive management. Costs, I think it's very obvious. You go back to the pizza example. Fine dining should usually be more expensive than going to Pizza Hut, unless you've got a really good deal. Same difference between active and passive. And how do you choose? I think this is the most important one. I think passive funds are useful when, one, you don't have time to do research. Again, in the pizza analogy, you're in a hurry. You don't want to choose. You're sitting in China and you're on a work trip and you're worried about standardization. You just want something that is simple. Active funds are for people who have the time to choose, who have advisors and distributors to give you guidance, or who know how to make those choices. And the reality is that there really is no black and white answer. There are honestly merits to both approaches. With a passive fund, you get simplicity, you get cheaper fees, but a passive fund will never outperform an index. There are cases where, in an index, a particular stock or sector can run up artificially, and the passive fund does not have the option to be able to not hold it. I'm not taking individual stock examples. A passive fund can't hold cash in a portfolio. So passive fund is very standardized. So there's a lot it can't do, but you know what you're getting. So if you want the standard, it gives you that. Active funds have a lot of flexibility. They can take defensive positions to reduce losses. They can be a lot more agile in which stocks or sectors they pick. They can hold cash in some case if the mandate allows, in case of high valuation. But as I said, active risk can also go wrong. Now, how do you evaluate what matters when selecting an active or passive fund? So let's start with a passive fund. What matters in selecting a passive fund? Actually, very few things. The first thing you want to check is what is the benchmark, because a passive fund is as good as its benchmark. And by the way, there are some really bad benchmarks out there as well. So if you're buying pizza, you want the manual for cheese pizza because that's all you're going to get. Now, once there is a manual, once there is a benchmark, and the benchmark could be something like a Nifty 50, it could be something like a Nifty mid-cap index, it could be a fixed income benchmark, it could be a combined benchmark. You want to see the passive fund's ability to mirror the benchmark. It's like if there is a standardized guidance of how to make pizza, margarita pizza in all Pizza Huts around the world, a Pizza Hut sitting in India might not be able to procure the right cheese and will make something marginally different. That marginally different, that difference between what you should do and what you actually end up doing, is what we call tracking error or tracking difference. And ideally, you want your tracking error or tracking difference to be as low as possible. And third, of course, cost. It's a standardized product, so cost is important. In an active fund, just going back to a restaurant, what's important? The pedigree of the AMC or the restaurant, the experience of the chef or the fund manager, the ability to actually provide something different, a clear and consistent strategy. So I do believe there are multiple ways to run investment strategies, and all strategies do well if you stick to them consistently. But clarity and consistency of investment strategy is extremely important. And of course, fair fees. You will pay more than a passive fund, but it has to be fair. And thankfully, in India, funds are so well regulated that this isn't a problem. One of the unfortunate myths about active and passive funds is that it is about returns. That, I see all kinds of headlines saying, oh, you should do large cap passives because large cap funds will never beat the benchmark, etc. I don't think we can predict, because in different cycles, and this is just some really interesting data, this is a period between Jan 20 to Jan 21, where if you look at it, a number of active funds, so you can see large cap category here versus benchmark, underperformed the benchmark. But that was because the market rally was concentrated in a very few stocks. If I just change the period to a period where markets were down actually, and there was a big correction, all active funds outperformed benchmarks. So it's very hard for us to predict when one kind of fund will outperform the other. I always think performance is not the reason you make the decisions. Your needs are the reason you make the decisions. Do you want something simple, basic, and standardized? Or do you need something where the insight and experience of a chef matters? Performance definitely is a tricky criteria. And I really think when you believe this, you don't have to choose. So you can today build a portfolio that is a blend. Let me give you an example. A passive fund is great if you want to invest in a basic instrument like gold. A passive fund is great if you want to invest in a target maturity fund, which is giving you FD-like exposure on a mutual fund platform, something like Bharat Bond. If you want simple NASDAQ exposure. Now, if you want a fund that is an asset allocation fund, that's much trickier to do in a passive fund. If you want to do something where stock picking, understanding management quality is extremely important, like small cap, an active fund is almost a necessity, because the small cap index has 250 stocks. A lot of those companies are not very good quality, and we run one of the largest small cap funds in the country. Small cap is really about identifying companies with strong management, not making mistakes, and that's where the domain of an active fund can be very powerful. We run another category just to illustrate an example of a fund. If you want to invest in a fund where it's looking at newly listed companies, IPOs, perhaps buying passively all IPOs is not a good idea, because not every IPO makes money. But if you had an actively oriented IPO fund where the fund manager was exercising discretion on which IPOs to buy, that might be a better way to do it. So the reality is you have to build a portfolio that's a combination of active and passive. And let me give you a personal example. My son is 1.5 years old, and I wanted to build a portfolio for him for his college education. Now, here's what I did. I picked a large and mid-cap index fund, which is just an index fund that gives you exposure to the top 250 companies in India. Because I said it's 18 years, he needs a simple solution. Let's just get something that's a good representative of the Indian economy. But I also wanted, since he has risk appetite, to give him a small cap fund, because I do believe that segment will do well. As I said, in small caps, I believe active funds will do well. So he's got an SIP into an active fund there. And then I picked an international fund. I picked a tech fund. Again, I picked an active fund there because I think tech is about active management. So here was a portfolio solution created for someone with one passive fund and two active funds. And that's really about how you go about building portfolios. For you as a consumer, there is no choice. There are options and you make the best decision. And as I said, it's not either, but it's marrying both styles. So, you can have passive funds in a portfolio, as I said, debt passive, some basic large cap ETFs or index funds, and some of these deeper styles, mid cap, small cap, thematic funds, flexible cap funds, can be done in an actively managed way. Finally, I would say it's always about the solution. Ask yourself why I'm investing. And to go back to my example of buying pizza, if you were going on a business trip in China or Japan where you struggle to go to restaurants and understand even the language, I've traveled in China and I've gone through this. Sometimes my family and I would just rush to Pizza Hut because we knew what we wanted. We knew it was vegetarian. We wanted a quick meal over lunch so that we could hop over to Disneyland or wherever we were going. But if I were taking my husband on an anniversary dinner, taking him to Pizza Hut might not be a very good idea, because what I really value is the food, the experience, the ambience, and I'm ready to pay a little bit more for that. So always think about the purpose behind what you're investing. And remember, it's never about either or, it's always about and opening more solutions. With that, I'll stop and open for questions.
Thanks, Radhika, for the insightful presentation. It was quite informative. We'll now take a few Q&As. I think there are about 30 odd questions, but I'll try and bunch it up together. So we'll start with the question. Yeah.
Yes.
But let's just start. You wait for the next 20 minutes and maybe it'll travel. So, so the first question I'll pick up from Priya, and she asks that employees who are actively engaged in 9 to 5 jobs, they don't have the time to actively search for good ideas and invest and take active calls. So how do they go about building a portfolio which is diversified across asset classes and also across investment horizon?
Yeah, I think as working professionals and parents and family members, we all are super busy. I think there are two choices. One is that for many people, I recommend go to an advisor. That's exactly why the advisory profession exists. Including the folks on this call, an advisor can guide you through the basic categories of funds that you need to invest in and the basic options in each category with the research that comes with experience. If you have the experience to do it on your own, that's the call you can take, but then you really need to have the foresight and experience to be able to do it on your own. So I think those are the two options. I would say investing is not so complicated. And today there is so much content available on investing. Regardless of whether you go with an advisor or do it yourself, I think it is extremely important to be informed.
So move to the next few questions, and these are more related to the active and passive style of investing. So there are questions whether STP and SIPs are active style of investing, or it also entails some other way of managing investments.
So SIPs and STPs are features. They can be employed in both active and passive funds, and they are a way to deploy cash. Now, if you have 100 rupees, you have, and I'll come to SIP separately. If you have 100 rupees, you can either deploy 100 in the market, or you can say, I don't want to deploy it in one shot. I want to deploy it in a staggered way. And that staggered way is an STP. So you deploy it in 5 tranches of 20-20-20. How to do that is individual. For instance, if you believe that you're not comfortable deploying 100 rupees in equities, that may be it. If you believe the market has run up too much and you want to do it in a gradual way because there's some major event in the economy, it's a call. SIP is a savings tool. So for those of us who are salaried professionals, and I think the previous investor asked that question, an SIP works if you have monthly income and want to keep investing it on an ongoing basis. For salaried professionals, by the way, I believe SIPs are one of the best ways to invest because it's automated and it gets market timing out of the window. But active versus passive is not SIP. Both SIP, STP are tools that can be employed in both active funds and passive funds.
Sure. Another question is on, and I'm going to extend it to be meaning that core and satellite approach of portfolio management. Is there a way to use active and passive style within the core part of your portfolio and something else in the satellite part of the portfolio?
So I like core and satellite as an approach, and many people have different ways to think about it. But when I think core and satellite, core basically means finding 4 or 5 meaningful categories of funds that constitute 80% of your portfolio. For most people, that could be large cap, mid cap, small cap, fixed income, and international fund. Satellite could be thematic ideas, credit, anything else. Now, again, you have to go category wise and see what style of investing makes a lot of merit. So in your core portfolio, maybe you say large cap, I'm going to do passive, mid cap and small cap, I'm going to do active. In your satellite portfolio, again, you do that same analysis. So it's really about understanding different parts of your diet and saying, do I do this in-house or do I get this done externally? And both active and passive can be applied in both core and satellite portfolios.
Sure. Now we come to some pressing questions which have been very topical over the last couple of years on the efficacy of fund managers to deliver alpha, especially in the large cap spectrum.
Yeah.
The questions come like, are they worth it? Is large caps better played through index funds? Do the cost, do the fund managers justify cost on the large caps?
So in the long term, if a fund in any category has to exist, it has to beat the benchmark. I think this goes without saying. The predictability in India of a fund being able to do so is a tricky one. So I remember when I joined the industry in 17, 18, no large cap fund was beating its benchmark, and this huge narrative started about let's do large cap through passive funds. Incidentally, over the last 1 year, most large cap funds have beaten their benchmark by 4-5%, but mid cap funds have not. So sometimes looking at 1 year data is not very efficacious because it really depends on what is done well in the index. For instance, there was a particular promoter group in the mid cap index that has done extremely well when most of the industry and most active managers have believed for whatever reason that they don't want to hold that promoter group. Now, is active management bad? Only time will tell. In general, the belief is that certainly in the mid and small cap segment, active investing is more powerful. Perhaps as large cap companies get a little better researched and are so widely covered, there is more merit in passive investing. But as I said, my whole thesis has been rendered a little weird over the last year because large cap funds have mostly smashed the benchmark. That's why I said, I think my decision, I picked a large and mid cap index fund for my son, but my reason was really I just wanted simplicity. It was not about trying to play these performance games.
So since we're on the topic, is the cyclicality of active managers' ability to add alpha over the benchmark, has it got anything to do with risk aversion, markets preferring good quality or larger balance sheets over weaker ones?
It's gotten to do, I think, with the kind of rally, how broad-based the rally is. So if a few stocks tend to do well, then passive funds tend to do better. So there was a phase, if you remember, there were some stocks called the Hrithik stocks, etc. There were the 5-6 stocks that were driving the index. Then passive funds do better. One has generally seen in an extreme correction, for instance, active funds tend to do better because there some of your less high quality names don't do well, and active funds have done a good job avoiding them. So I think it depends on volatility. In the highest rally, stock selection works well, so active funds do well.
Sure. So the next few questions are on how to choose a good passive fund. What are the metrics to look at, and specifically on the cost or the expense ratio or the tracking error, what could be the range which could help you decide?
So I think 3 metrics. What is the benchmark? Please study the benchmark. There are some passive funds with really terrible benchmarks out there, and a fund is as good as its benchmark. So, for instance, if you're investing in a benchmark which has 8 stocks, regardless of what the passive fund does, that's a pretty risky and pretty bad benchmark. So, one, look at the benchmark. Tracking error should be in the range of 1% odd. I think there's a SEBI prescribed limit at 1.5%, and funds have to disclose it. But most funds are pretty careful about that. That's the second thing that you should look at. Costs. I would say in India, again, in equity, passive funds are capped at 1% in the regular plan, if I'm not wrong. So that's where costs are capped. And of course, you can look at individual costs. I mean, these are the 3 ways to choose a passive fund. I really can't think. The one point I do want to make, I don't know if it was clear in my presentation, is there is a myth sometimes that index funds are less risky. To my pizza point, in both cases, you are eating pizza. Now, there are 2 kinds of risks. One is the market risk, and second, or the asset class risk, and the second is the risk of the fund manager. In both funds, you are carrying the asset class risk. So if you're investing on a gold active or gold passive fund, you are carrying gold risk or small cap risk. The additional risk you're carrying in an active fund is the fund manager's ability versus the benchmark, but never for once believe that either isn't risky.
Sure. The next question, is on rebalancing. Is it okay to sell when the markets are high and invest when markets are correcting? I mean, maybe the question is on tactical opportunities while we are following the active or passive style of investing.
Yeah, so this one isn't really about active or passive, but I think having a strategic asset allocation is important. So saying, and those are complex words, but saying broadly, I'll be 40 large cap, 30 mid cap, 20 small cap, 10 international, hypothetically, or whatever it is, you can add fixed income, gold, etc. And trying to stick to that. So for instance, if your equity portfolio has run up a lot and mid caps, instead of being 20%, have become 50%, you probably need to rebalance. I think you have to find a balance between rebalancing, not paying crazy taxes and costs, because that is also a reality. And of course, so in my own portfolio, I do tactical rebalances every year because that is also more tax efficient, and longer term big strategic rebalances every 3 to 5 years.
There's an interesting question, though a little unrelated from the topic of today. Value investing versus growth style of investing. Could you help us understand which phase of country or economics growth are we currently, and what should investors do?
So Edelweiss has an interesting view here, and we do think companies are companies, and we specifically say in our own investing framework, we don't want to be value or growth investors. We will have some companies in our portfolio where the price appreciation should come from the fact that the stock is underpriced, and some where the price appreciation might come from the fact that the stock could grow faster than market. So we don't want to be wed to a single style. We believe cycles in India will change faster, and in the world will change faster than we expect. And by being wed to a certain style, your performance can be very, very cyclical. So for us, that's important. And investors, I talked about emotions, do a slightly poor job of timing when to do value and when to do growth. We had a great period of growth, and I don't think anyone was talking about value funds. And now that growth has suffered and value funds have done well, everyone wants to jump into value. So we believe companies are companies, and portfolios shouldn't carry such a bias.
Sure. Another question, though not related, but are there any specific themes related to ESG, like specific to waste management or other related topics that you see are gaining importance in India and can be investable?
It's interesting that as you asked this question, I read an article today that BlackRock and State Street, two of the world's largest managers, just shut down their ESG funds and shut down ESG as a concept. So I have not believed that ESG should be something that one should look at from a fund specific point of view. I think given the state of India's markets, ESG disclosures still have a long way to go. So to build dedicated funds and ideas around this is early, and we don't even have evidence of this being a success in global markets. I think if you were to build a fund on water waste management, for instance, you wouldn't even have a large enough universe to create an active or passive fund. Some of these themes can be reflected by a fund manager's view in an active fund because there you don't need a whole universe.
There's another question, though it looks a little misplaced, that in fund managers or funds do not stick to the mandate. For instance, mid-cap funds would have less than 30% in mid-caps, and large caps, flexi-cap would have 70% in large caps. Is that true? Or I think after SEBI categorization, I think it has become very straight-jacketed.
Yeah, I don't think that should be the case. In fact, for us, it's very important, this mandate question. So mid-cap funds should have 65% exposure in mid-caps, and I think they have to do so by law. Sometimes, for us, we say that our mid-cap fund has 65% in mid-cap, and we will never buy a single large-cap name in our own mid-cap fund, even though that sometimes means the fund is more volatile. So 65% you have to stick to. Beyond that, the manager has discretion, and there, as I said, for us, we specifically say in a mid-cap fund, we will never buy a large cap name. Now, if a mid-cap becomes a large cap, then we might take some time to sell it. Flexi cap funds, yes, do have quite a bit of large cap exposure, could be 60, 70, 80%, but that's not off mandate. It's because the benchmark of flexi cap has 70% large cap exposure.
Uh, is averaging a good strategy or good option to rebalance a portfolio, or is it a dark concept?
Not a dark concept. I think, for instance, if you're doing SIPs and you top up those SIPs when markets correct, it can only help your returns. Very simply.
Is an active fund manager transparent to investors of all the transactions being executed with investors' money? I don't know why this question keeps coming as an
They have no choice
allegation on
but to
fund.
be. The law requires you to be. There's an AMC balance sheet and an AMC for buy scheme. There is something called a scheme financial statement that has to be published and shared with investors every year. So you need to see all the transactions that we've done. We have no choice.
Yeah, and a related question on conflicts of interest from the perspective of fund managers, how compliant are they, and how ethically or morally inclined they are to live up to the mandate?
So I see quite a few of these questions, and I think, having worked in a number of different global markets, India perhaps has and you guys will think I'm a little biased, India perhaps has the strictest mutual fund regulations in the world in terms of the kind of compliances that we expect from our people. Everything from your fund manager's salary to the commission your broker earns to the transactions we are doing to the fees we are charging is very well disclosed.
Sure. There's a very interesting question specifically on index funds. Are they in some sort of bubble because there's a lot of money seem to be chasing them? And another related question is, yeah, good.
No, I don't know why this index fund bubble question keeps coming up. I mean, an index fund is just a way of investing in basic asset classes. So the conflict, I think the construct of an index fund can't be a bubble.
Yeah. So there's an investor, and he writes that he's closing the age of 70, and still does not have a good understanding whether he should keep remaining invested through SIP, particularly because he's the age of 70, or he should start exiting. Should he have a point at which he can start exiting from his investment?
So it really depends, right? Because I think age is not really a determinant. Now, it really depends on your financial. Like for my instance, my father is a 70-year-old. He's far more aggressive than I am because he's got a pension. He doesn't have home liabilities and he's got working children. So can he be very aggressive? He can. But if you are someone who does not have some of those things, then perhaps it's a time to move your SIPs maybe from an equity fund into a hybrid fund. So I think age in itself, with age, I can't answer that question.
Sure. Now, coming back to more larger questions on emerging themes, areas of opportunity over the next 5 to 10 years, given that a lot is being written about India's transition into a middle income economy, India the bright spot, the best investing destination. What are some of the major themes that can be investable and investors could stay invested for a longer period?
So, firstly, I get this question about themes a lot, and I do believe that if you look at India over the next decade, you actually don't need to chase too many themes, because if the economy is going to become a $5-6 trillion economy, the reality is there is a meaningful story in many, many sectors, whether it's healthcare, financials, tech, manufacturing, etc. And investors don't do a great job at timing themes, especially exiting themes at the right time. So sometimes a diversified fund is able to service investors better. And if there are a few themes to be focused on, then a fund manager can reflect them. That said, one place where we think there will be incremental opportunity is the whole manufacturing side of the economy. Historically, a big contributor to the markets has been consumption companies. But the whole manufacturing side of the economy, as private investment and capital expenditure picks up, I think will be a very interesting place.
Now, finally, coming to the debt side of it, there's a couple of questions on debt as well. How do you see FDs versus short-term debt, especially in the context of short-term parking or 1 to 3 year investment horizon?
I think for short-term parking, mutual funds do a very good job because of the easy liquidity. There's no breakage cost, etc. One category of funds that I think is very tax efficient for short-term parking in the 1 to 3 year category is the arbitrage fund. So it's a fund that's got equity-like taxation, which means 10% over 1 year, but it's got fixed income-like return. So that's what I use for 1 to 3 year parking.
Another question that I'm sure you must be getting quite a lot is, with the indexation benefit getting away from fixed income funds, mutual funds, what's the argument for the debt mutual funds still as against the FDs?
The argument is this, that now the tax is on par with FDs. So you really have to compare them pre-tax. As I said, for instance, in a mutual fund structure, you get 10 to 12 year products, which you don't get in an FD structure. You get liquidity. So there are benefits of that structure. You don't have to pay tax every year. Your taxes default. So I think there are still a lot of benefits. The other thing I would suggest is you look at hybrid funds, which are a very tax efficient way to have equity and debt exposure. So a fund category like aggressive hybrid is super nice, for instance, 75-25, tax efficient.
Now, coming to optimization of portfolio through overseas investment, international opportunities. One, do you see value in that? And second, what are some of the geographical opportunities that you see in the current context?
So for an evolved investor, yes, and I know SCB has been a big believer, have 10 to 15% international exposure. And I think, to quickly sum it up, the two markets that we believe you should have exposure to are US and China, the two largest economies in the world.
Yeah. And there's a related question on China specifically. For 2 years, it has been disappointing. There was a brief spurt on rebounding euphoria, but do you see more stimulus coming in? Chinese equities likely to rebound?
No, I think a lot of the worst of Chinese equities has, is factored into the price. Let me say that China is going through a change and a transformation, and I can't bet too much against the world's second largest economy.
Sure. So I think we've covered most of the questions, and specifically, we've touched equities, active versus passive. We've touched about optimization of portfolio. What are the three things, Radhika, that you would advise our investors at this point, given that we are heading into a period where we'll see elections, where we are anticipating global growth slowdown? So there are all the ingredients of increased market volatility going ahead. So what would be your advice over the next one year or so? Investors should avoid panic. What should they look out for, and how should they go about investing?
I think one, keep a check on your asset allocation and the diversification in your portfolio. These are times when we let exposures go out of control, so don't do that. Two, know that there will be volatility. If you can't use it as an opportunity, please don't panic. And third, don't buy anything that you don't understand, because a lot of these weird things come up in a bull market. So no FOMO.
Right. And before we officially close the webinar, there are a few questions which I was avoiding, but it seems it's important. What's your view on those asset classes, the new age asset classes, which we often don't understand about, cryptos, bitcoins? There are a lot of other opportunities being written on the advent of AI.
My views on crypto are known in public domain. I don't understand asset classes that are not regulated.
Okay. So that was a part of your earlier statement, that don't invest in something that you don't understand.
That you don't understand why it goes up just because everyone else has done it.
Thanks a lot, Radhika. Thanks for being such a good teacher, and it's been quite informative. There have been over 78 questions that we've had, and I think we've bunched it up together and we've answered most of it. Some questions we've had to avoid because these are very stock and specific to some security, so we've avoided. But I think we've done a good job in terms of taking most of it. We'll just wait for another couple of minutes. We'll play a video on our SC Invest capabilities.
Want to invest but still figuring out how to start, where to invest, or whose guidance to follow? How about an investment tool that brings together industry-leading solutions in one place? Presenting Standard Chartered Invest, your one-stop online investment shop. What does it do for you? Well, for starters, there's no paperwork to open an investment account. And if you are confused about where to start investing, just tap to view our pre-generated SIP packs based on your risk appetite. Not just that, you can get theme-based fund ideas too as per your investment needs. With comprehensive market insights at your fingertips, now you can easily keep track of the markets and get access to detailed reports, so that you can make informed investment decisions, monitor the performance of your investments, and realign them as per your convenience. And no matter where you are, transact on the go while having complete control of your investments in your hands. View all your holdings, buy new funds, and do a lot more with your SIPs too. You can pause or cancel your SIPs whenever you want, or resume as well as redeem them anytime as per your wish. All this and a host of other benefits just waiting for you to explore on SC Invest. Get set, invest today. Simply log into online banking or the SC mobile app. Download now.
Thanks, everyone. Thank you for joining. We'll meet you again next month with another interesting topic. Thank you, Radhika. Thank you for joining us.
Thank you. Thank you all.